One of the questions we get very often is, should I just invest in bonds now and wait until things are clearer? As we see over the last 28 years, interest rates have been falling from their peak in 1982 until where they are today. So bond investors have had a headwind to invest in bonds. So they've got their yield, and then they have their appreciation from this 28-year decline in interest rates. Unfortunately, investors are very good at tracking what has done good recently, and that's where they put all their money. So we've been burned in the tech bubble and recently with the 2008 financial crisis. So what people are saying now is, well, look at these bonds. They've done phenomenal. The last 28 years, they've outperformed the stock market. So that's where they're putting their money. What I did here is I took a look at stock fund flows versus bond fund flows. I looked at the tech bubble, all the money that was pouring into stocks at the absolute worst time, and money that was pouring into bonds in the last 2 years. More money has gone into bonds recently, about $592 billion, than had gone into stock funds during the go-go 90s, where people were buying pets.com and anything that ended in .com without any profit. So to me, that's a warning sign. Now, I'm not saying it's time to sell all your bonds. That's not what I'm saying. But I think investors as a whole, as individuals, have gotten too conservative based on this poor decade that the market has had. So like I said, it doesn't mean I want you to take your 50-50 portfolio and go all stocks. I do think that some people with long-term horizons that aren't going to spend the money within 20 years have gotten too conservative, gone maybe all to cash or all to bonds. And I don't think that is a strong investment philosophy to combat inflation over the long term. To give you an idea of what could happen in treasuries over the next few years, I put this chart together just to show a 1 year, 1% change in the different duration treasuries. It goes from 2 years all the way to 30 years. Probably the most common, I'd say, is between a 5-year and a 10-year treasury. So a 5-year, if interest rates just go up 1%, you could have a loss of roughly about 4.83%. So a lot of people haven't been thinking about that because the last 28 years of the bond market have been falling interest rates. And they've looked at that, and unfortunately, like I said, they're chasing what's done good recently. But if a 10-year treasury goes up 1%, you could have a loss of 8.63%. Is it realistic that a 10-year treasury could go up 1%? Well, at the beginning of the year, treasuries were at 3.85%. So they don't even have to go up to where they were at the beginning of this year. So there's a very likely possibility that interest rates will rise 1%. I'm not saying it'll happen tomorrow, but over the next year, let's say, interest rates will start recovering. So people have been moving out of bonds. And unfortunately, this has been one of the best times historically to invest in stocks, the third year of a presidential term. So historically speaking, the average rate for return has been 17.6% in the third year of a presidential term. This doesn't mean it's some trading strategy where you should dump all your money into equities, but historically speaking, that's been the best time. Also, I didn't include this chart, but you can take a look at what the best houses, the House versus the president, Democrat versus Republican, is for the stock market. Historically speaking, the best has been a Democratic president and a Republican House. The reason I bring that up is, again, I'm not trying to say put all your money in stocks, but I feel as investors as a whole have gotten more conservative by pushing all their money into bonds. Gone are the days when Warren Buffett would buy Coca-Cola and hold it for many years. Individual investors, unfortunately, are turning over their portfolio. They're watching that show where they're ringing the bell and blowing the horn, thinking that if they're not doing something, they're missing out. The average holding period for a stock is now 6 months. So, as we saw earlier with my charts that I was discussing, analysts are wrong more often than they're right. And if they're basing their decisions on forecasts of these analysts, unfortunately, they're just hurting themselves. So the average period is now 6 months. It peaked back in the 1950s. People buy AT&T and hold on to it forever. However, people aren't doing that anymore. Unfortunately, that's really hurting their performance. What we took a look at is the average investor return versus the actual stock fund return. So what this measures is how did the actual investors actually do over this period. Over the last, let's say it's 16, 17 years, the average stock fund has been up 8.8%, while the average stock fund investor has only been up 3.2%. So the reason this is because of that previous slide where people are trying to turn over their portfolio, trying to watch those trading shows, and getting in and getting out at the absolute worst time. And now they're piling all their money into bond funds, unfortunately. So historically, the best thing for an individual investor to do to avoid volatility, there's two antidotes to volatility. Simply speaking, they're time and diversification. Over the 1 year period, the worst year for a stock is roughly down 43%. The best year was up 56%, so that's a pretty big spread there. So individual investors trying to make decisions based on these huge swings over a 1 year period, unfortunately, it's like a roller coaster. But if you simply add a balanced portfolio to the mix, let's say if you have half stocks, half bonds, that worst 1 year period has already dropped down to negative 15%. So it's actually, just by diversifying your portfolio, has been an antidote to volatility. And over the long term, you really haven't given up that much performance by having a diversified portfolio of bonds and stocks. Over the 20-year period, roughly speaking, the stock market has performed about 10%, while the balanced portfolio has performed about 9%. So you've given up about 1%. Granted, that's been during a period of, as I mentioned, 28 years of falling interest rates. But historically speaking, you haven't given up much by having a diversified portfolio. So if people are looking for ways to control risk in their portfolio, it's very simple. It's just be patient and wait, and don't try and turn over your portfolio repeatedly because it'll actually hurt your performance. This chart I included just to give you a perspective of over the long term. This is since 1900. This is the Dow Jones Industrial. Over the long term, markets recover. We had the crash of the Great Depression. We've now had the financial crisis. We've had the tech bubble. We had the market crash of the 1980s. The market, over a long period of time, recovers and rewards patient investors. So what I'd like to do today is leave you with a few ideas I think that are key, but I don't think a lot of people actually follow these. You've always heard buy and hold, but as you saw from the chart earlier, I don't think a lot of people are actually doing it. So chasing returns and market timing hurts your overall performance. Now, I've been saying it for over a decade, but unfortunately, a lot of investors aren't listening. They're still trying to get the next best thing, and ultimately, as you saw with that investor return slide, they've actually been hurting their performance quite significantly. Crises are inevitable. Bad things will happen again. Unfortunately, that's par for the course, and you can't just sell your entire stock portfolio and wait for things to recover, because unfortunately, as Warren Buffett says, you overpay for rosy scenarios. So it's important just to stay the course, and for the long term, stocks have rewarded patient investors. The most important point I will leave you with is to develop a sound plan and stick to it. Thank you very much.